It's a scene playing out all across the country.
I've tried my hardest. I'm sorry. I'm so sorry.
These are the faces of economic catastrophe.
We've got a court order here to go ahead and proceed with an eviction today. Basically, the bank's taking back over the house.
People losing homes, people losing jobs.
This is not your ordinary run-of-the-mill recession. We are going through the worst economic crisis since the Great Depression.
The question is, how many of us really understand why? Tonight, we'll explain it step by step. But to begin, what you really need to know is that the meltdown happened because of the failure of that one simple building block of the American economy, the mortgage.
Home ownership is the basis of a happy, contented family life.
Way back when, a mortgage was a great way for the average American to own a home.
Now, this is the way your payments will work out.
It was simple. The bank would agree to give you a loan, and you'd agree to pay it back over time with interest.
This is a dream come true for us, owning our own home.
Banks were careful about how they loaned money. They needed that money paid back to protect their depositors and stay in business. For generations, it worked.
Want to refinance and get cash?
But oh, how things have changed.
I'm an American mortgage specialist. I'm here to help.
Because in the last decade, it seemed like anyone was able to get a mortgage. Take the case of Paula Taylor, who had a dream of owning her own home.
The American dream. I come from a large family, 13 children. One of the second people to own a piece of property. That felt good.
But could she really afford to own a home? A few years ago, she considered herself virtually homeless, spending nights with family and friends.
I would go to the place where I had my stuff stored, literally pack it in a suitcase, and then for that whole week, lived out of a suitcase as I went back and forth.
Then she saw a condo in this house near Boston. The price? Over $250,000. She says that as a personal trainer, she was making less than $20,000 a year, $1,600 a month.
I really wasn't educated in what it takes to get a mortgage. I knew that you give them your information and they run the numbers and they tell you whether or not you can afford it.
There's a formula. I either fit in it or I don't.
Correct.
The mortgage company determined Paula did fit in and gave her 2 loans to cover the full amount of the condo, $259,900. Her monthly payment on those loans, more than $2,100, even though she was taking in only $1,600 a month. Paula planned on making up the difference by having her sister move in and splitting the cost.
I was assured after a year you can refinance. And so in my mind, if I pay this for a year, then I can refinance and get into a better loan.
Loans like the one Paula got were being handed out by the millions, and even she now wonders why.
Why would they tell me, as the lender, that I can afford this if they know they're not going to get their money back?
Some consumer finance experts, like Elizabeth Warren of Harvard Law School, think there was method to the madness, which she compares to salesmen hawking products they know are defective.
This is about buying toasters that at the moment they were sold, the person selling them knew these things are going to explode.
This is a typical residential street in Santa Ana in the heart of Orange County, California. You could call this the epicenter of our nation's financial meltdown, where many homes like this are now in foreclosure. It might be hard to believe, but 3 years ago, this house sold for $585,000. All of it borrowed by a man who probably thought he could afford it. But less than a year later, he defaulted, and now the house is up for sale at auction, if anyone would even be interested in buying it. But why would a lender issue a loan that a borrower might never pay back? Some blame the problem on a good idea gone bad. Beginning in the 1990s, Congress made it easier to get a mortgage.
70% of Americans who own their own homes today, in no small measure, do because of the work that's been done here.
The rules for lending were eased so more people could qualify for mortgages. And with millions more now qualified, the lending business boomed.
I'm with Countrywide, and I got them all approved.
The biggest player of all, Countrywide Financial, run by CEO Angelo Mazzillo. It was Countrywide that loaned Paula Taylor nearly $260,000 to buy a condo, even though she was clearly unqualified. So what was the incentive? Well, first, salesmen were paid commissions for every loan they wrote, and the lending companies collected fees. But there was a much bigger incentive to make as many loans as possible. A pot of gold overflowing with riches, a scheme powered by some of the biggest financial institutions on Wall Street. But it was all destined to fail.
It blew up because it was based on a scam.
Few people know more about the financial crisis than Harvard law professor Elizabeth Warren.
Down at its heart, it was based on selling mortgages to people who simply weren't going to be able to pay them off.
It was all based on a series of lies, beginning with the loan application. On Paula Taylor's application, it said she earned around $90,000 a year, $7,300 a month, even though she says she told them she took home only $1,600 a month. She says she never noticed that inflated income until we pointed it out to her.
So you didn't put down that you made $7,300 a month?
Oh, no. Absolutely not.
Well, if you didn't, who did?
It had to be them in order to finagle the numbers to say that I could afford this property.
Would a reputable lender do such a thing? Deliberately lie?
Throughout the industry, they were called the liar loans.
Karash Parto once ran Countrywide's operations in Alaska. He's speaking out for the first time.
Liar loans.
That is correct.
Officially, they were called stated income loans.
There was no independent verification of salary, savings, investments. And this was official procedure.
Absolutely.
He says they even joked about it.
If you have a pulse, we give you a loan. If you fog the mirror, give you a loan.
He says if borrowers didn't lie, sometimes loan officers did it for them. Federal authorities caught Parto, and he spent a year and a half in prison for processing liar loans on behalf of a real estate speculator. When Countrywide found out, it fired him and others in the Alaska office. But Parto insists the practice of faking loan applications was rampant, and everyone in the business knew it.
So you're saying top company officials knew borrowers were submitting false applications?
It's impossible that they didn't know.
Countrywide executives portrayed Parto as a rogue who violated company standards. But listen to Bob Feinberg, who worked at Countrywide for 12 years.
Rogue?
You buy that?
No, I don't buy the rogue. I think it was infested.
Feinberg says that when he started, Countrywide was ethical and by the book. But then, things just went haywire, pushing loans borrowers couldn't afford, with interest rates that could adjust and go way up.
What's wrong with that marketing?
Because you're going to put them into a loan that's guaranteed to fail.
In Michigan, Linda Johnson, a retired school principal, lived in this house for 26 years. Then when her daughter got into an Ivy League college, she decided to do what millions of homeowners were doing: refinance, taking out a new loan for more money, paying off the old loan, and using the extra cash to pay tuition.
What kind of a mortgage did you think you were getting?
I thought I was getting a fixed mortgage.
But the interest rate wasn't fixed. It was adjustable. Like many borrowers, she acknowledges she didn't go through the loan papers in detail, so she was shocked when her mortgage later jumped to nearly 12%. To keep up with her loan payments, she ended up borrowing money from her pension fund.
I made the payments on time.
At what cost to your retirement plan?
I've taken out everything I can take without a severe penalty. And so...
And how much longer can you hang on?
I can't. I'm tapped.
You're done.
I'm done.
Another homeowner drowning in debt, even though she thought her lender had her best interests at heart.
Let's be real clear about this mortgage crisis. This was not about getting people to own homes.
Elizabeth Warren says mortgage companies were more interested in profits and selling as many loans as possible, especially risky loans to risky borrowers. Why? Because the riskier the loan, the more a borrower had to pay in interest. So sales reps were paid bigger commissions for bringing in those riskier loans.
Mortgage brokers got paid a higher premium for selling every customer a worse product. They actually got a sheet of paper every morning that said, in effect, If you've got somebody who's got this credit score and this much down payment and wants to borrow this much, if you sell them something clean, we'll pay you $500. If you sell them something a little bit dirty, we'll pay you $1,000. If you sell them something really dirty, we'll pay you $4,000. That's how mortgages were being sold in America.
From 2001 through 2007, more than 105 million mortgages were sold, totaling more than $17 trillion. With so much mortgage money available, sellers could practically name their price, so home values kept going up. That means the mortgages also got bigger, and risky or not, lenders were happy because the higher the dollar value on a house, the bigger fees they collected. Which brings us to another lie, the house appraisal.
The appraiser would say, what value are you looking for? Well, we want this value. We want it to come in at 1.3. Oh, okay. And they'd go out, do their appraisal, and it would come in at 1.3.
In that kind of environment, Karash Parto says Countrywide made one bad loan after another.
There are some times we would say if it was my money, I would not lend it.
Take the loan made to Paula Taylor.
Does she seem like a candidate to buy a condominium valued at $260,000?
No.
There've got to be thousands of loans just like that.
More than thousands and thousands, hundreds of thousands.
How do you relate what went on at Countrywide to the financial crisis the United States of America is in today?
It's the match that lit the fuse. Me and my peers, we knew this would happen. Not to this extent.
At the end of the day, is this greed? Is it arrogance? Is it corruption?
Greed. It's always greed.
As we tried to untangle the mortgage meltdown, we were finding example after example of loans issued to individuals who simply could not afford them. David Carbajal, a gardener in Southern California, was about to be evicted from this house because he couldn't keep up with the payments.
Every month is $5,000 only for one bank.
$5,000 just for one bank?
Yeah, right now.
And that's your entire salary? It's more.
Yeah.
A lender gave him $600,000 to buy the house with no money down.
It sounds like a lot of money, $600,000 to borrow, when your salary is $50,000 a year.
He said he doesn't know.
But his story pales in comparison to that of Dolores Parker Jackson.
You have 4 condos, 6 mortgages, including the second.
First and the second, you're correct.
Totaling $1.3 million.
That is correct.
2 of those loans were funded by a company owned at the time by NBC's parent, General Electric. Problem is, during the year she got several of her loans, court records show she was essentially broke, telling the IRS her income was in minus territory. Even so, she told lenders she was bringing home at least $15,000 a month and could easily afford the monthly payments on all 6 loans.
The monthly commitment on that is something around $10,000 a month. That's a lot of money.
That was a lot of money, but that was not a problem. I had a very lucrative daycare.
Then why did she tell the IRS she was losing money?
This is actually your 2006 tax return. It shows a negative income of $6,813.
Was this my income?
This was the income for the year 2006, negative $6,813, which means you lost money.
She also has a history of filing for bankruptcy.
My husband filed bankruptcy, and so did I, in 1997, somewhere around in there.
Okay.
Yeah.
She was also evicted from this house for non-payment of rent. So how did she get all those loans? In trying to understand how the mortgage meltdown happened, we already knew some mortgage salesmen were willing to look the other way. But lenders are supposed to have underwriters, people whose job it is to review and approve the loan applications.
Where were the checks and balances?
They weren't really there.
It was more about money.
Eileen Loiacono was an underwriter for People's Choice, one of the lenders that gave Dolores Parker Jackson her loans. People's Choice said it had stricter lending standards than most subprime lenders. Still, Loiacono says that wasn't enough. She says that for administrative and basic personnel matters, underwriters there reported to sales managers. And as a result, she says, she felt pressure to approve questionable loans even when there were clear signs of fraud.
Falsified W-2s, tax returns, bank statements.
How do you even falsify that stuff?
X-Acto knives.
So cut and paste.
They would use someone else's tax returns, and then they put someone else's name in them.
And you saw this?
Oh, yeah.
She says she challenged about a third of all loan applications she reviewed at People's Choice, but was overruled by executives the vast majority of the time. And she says in a few instances, salespeople even offered underwriters like her unusual incentives to sign off on loans.
Boob jobs, cars, vacations, cash, jewelry.
Did you get any incentives?
I refused anything that was offered.
A spokesman for the company's former CEO says incentives to underwriters were strictly contrary to company standards. But Loiacono insists offers were made, and if incentives didn't work, there were other tactics.
There were threats and intimidation.
What kind of threats are we talking about?
Your tires would be flat.
Your tires would be flat?
Yeah.
It sounds like it was being operated like a loan shark agency.
It was. It was.
What could prompt such extreme behavior, and why, unlike bankers of old, weren't lenders worried that these loans might never get paid back? Because for the most part, they didn't have to worry. Some other financial wizards thought they had it all figured out. To understand the mortgage mess, you need to understand why a lender wouldn't be worried about lending hundreds of thousands of dollars to risky borrowers like Dolores Parker Jackson.
I didn't have any problems getting any of my mortgages.
Every month is $5,000.
Or David Carbajal. Or Paula Taylor.
Why would they tell me, as the lender, that I can afford this if they know they're not going to get their money back?
The answer is simple, because the lender was selling those loans and the risk that went along with them. Who bought them? Wall Street.
Wall Street was the end of the line. That's where the rubber met the road.
Well, the only thing he did say...
Paul Molo is one of the top reporters covering the mortgage industry and has written a book about the entire mortgage mess.
Why did Wall Street have such a big appetite for these mortgages?
Well, it's all about making money. I mean, they made money in all sorts of ways, so it was a beautiful thing for Wall Street.
Here's how it worked. Loans like the ones made to Dolores Parker Jackson would be combined with thousands of others into giant bundles worth millions and millions of dollars. Those bundles were bought by Wall Street firms like Bear Stearns and Lehman Brothers. Wall Street turned them into big investments called mortgage-backed securities, bonds that they sold to investors who collected interest on them. Wall Street loved it.
They ran a bond factory. They just wanted to buy those loans and make bonds as fast as they could.
Wall Street bought loans and sold bonds to the tune of trillions of dollars. And for a while, everyone was making out. Homeowners, lenders, and especially Wall Street investors.
It looked like it was going to be limitless for Wall Street. They thought it was going to go on forever and ever.
But in the frenzy, everyone seemed to forget one thing. Those investments were full of risky, some say toxic loans. Loans to homeowners who'd never be able to pay them back for houses that seemed to many to be way overpriced.
When all this boom was going on in home values, we'd all sit in our backyard with our kids and having a cocktail in the afternoon, and we'd see the house across the street sell for 25% more than it did 3 months earlier. And we'd say, you know, who the heck is buying these houses?
Many times the people buying those houses were the same ones taking out those risky loans, loans that ended up inside the bonds being sold on Wall Street. But how much did Wall Street know or care about those risky loans? Remember Eileen Loiacono, the underwriter? She left that mortgage company and got a new job with a consulting firm hired by Wall Street to review the loans it was buying. She says the job was less about checking out the loans than churning them out.
They're cracking the whip. Chris, they're cracking the whip.
It was like the chain gang.
Kinda. And they don't want you to question anything.
And when you raised that red flag, what did your superiors do?
I got in trouble.
Even when she pointed out obvious fraud, she says Wall Street took the loan anyway and packaged it into an investment.
That took the wind out of my sail. It took the wind out of my sail.
She says it should have been obvious to anyone that loaning money to people who couldn't pay it back meant big trouble. And even if lenders and underwriters were signing off on bad loans Wall Street wanted to package as investments, there was one last chance to catch on to the problem. Before Wall Street firms sold those mortgage-based investments, they hired companies like Standard & Poor's to give them ratings, so investors, mostly big institutions like banks and pension funds, would know the risk of what they were buying.
They were very solid investments.
Richard Gugliotta was an executive with Standard & Poor's. He says the company did the best job possible with the information it had at the time.
The historical experience of mortgage-backed securities was, plain and simple, these securities do not default.
They never had a problem before.
They never had a problem.
And even when Wall Street came up with super complex mortgage investments, ratings agencies thought they had a handle on it.
We had two guys who came out of NASA.
So you got NASA scientists.
NASA scientists.
But some critics say ratings companies disregarded risks to please the very same Wall Street firms that were paying them to rate those complex investments. Gugliotta acknowledges that 90% of the time, his team gave them the highest grade possible, AAA.
A skeptic may say, of course they're giving a high percentage of these away because they make money by doing this. What do you say to that?
Nobody was giving away ratings. Every single deal that went out the door had to meet our criteria standards.
Looking back, he says it's clear the ratings were too high.
So knowing what you know today, you would not have given any of these things tied to mortgages a AAA rating?
Correct.
How could this go wrong?
It's not the rocket scientists who were to blame. It was the lack of data to support some of the assumptions that were being made.
In other words, he says no one knew just how risky the risky loans inside those investments could be, even those NASA scientists.
I don't care if you're from NASA or Vassar. There was no history at all of a market where you were lending money to people with bad credit to buy a house and you were accepting down payments that were zero. There was no history.
You'd have thought someone would have asked more questions. But just as the mortgage companies passed the risky loans to Wall Street passed the risk onto investors. So in the end, no one bothered to go back and take a closer look at the actual loans that Wall Street bought from mortgage companies where some underwriters were pressured to approve loans. Loans for borrowers who'd never be able to pay them off.
Wall Street has got this reputation for being the smartest guys in the room. When someone from a reputable Wall Street firm calls you up and says they have a great investment, you tend to believe them.
And plenty did believe. Huge institutions, corporations, pension funds, government agencies here and abroad had invested trillions of dollars in a system they thought was sound. Some Wall Streeters had made out like bandits. For the rest, the end was near.
Here we are. You're rich. But what are the rest of us going to do?
The beginning of the end came in 2007.
We shall not be moved.
All across America, borrowers like Paula Taylor couldn't keep up with their payments. They defaulted.
Shame! Shame!
Protesters came out to support her, but authorities evicted her anyway.
I'm still to this day embarrassed about what happened to me.
As the bad loans surfaced, it set off a kind of nuclear chain reaction. Remember, many of those bad mortgages were bundled up by Wall Street and sold to investors. So when the loans went bad, so did those bundles, and the investments built from them. In fact, we traced Paula Taylor's mortgage. It was sold by Countrywide as part of a bundle of loans that was administered by the Bank of New York. That bundle was divided up and resold, with portions ending up in at least 2 securities, combined originally worth billions, both now virtually worthless. just a small fraction of the losses that across the board amounted to trillions.
Dire straits. Bear Stearns, one of the nation's biggest banks, suddenly on life support.
Wall Street giants like Bear Stearns and Lehman Brothers collapsed. The mortgage business dried up. The economy driven to the brink. So who's to blame, and who should be held accountable? Borrowers like Dolores Parker Jackson, who got $1.3 million even though she was basically broke?
There are going to be some people who see this and say, Dolores, you're an example of someone who took advantage of loose lending standards, borrowed too much money, and got in over your head. What do you say to them?
I don't think so. I don't think I got in over my head.
And yet it looks like she's going to lose her condos.
Do you take any responsibility for that mess, Dolores?
For the mess that I'm in right now?
The mess that you're in right now?
No, I don't take no responsibility.
So you're the victim here?
I'm a victim.
When you signed that mortgage, did you go through the documents in detail?
No.
How come you didn't?
Busy person, trusting person, American person. Before this all happened to me, I could not even envision Americans doing what's been done to me to other Americans. And that sounds really naive. But you can tell by my hair, I'm old school.
How much do you blame Countrywide and how much do you blame yourself?
I blame myself just a little bit. The bank had the upper hand in this. They were the one who came and said, you can afford this.
What about the people who sold the loans, like Karash Parto of Countrywide?
You know, and if you ask a loan officer, he's going to probably say, I blame myself a little bit because the underwriter was supposed to catch any mistake in the file. And all the way down to Wall Street and so on. Everybody blames themselves a little bit. Meanwhile, we have a major problem in this country.
So much blame to go around, and yet so few willing to acknowledge it. Like Richard Gugliotta, the former ratings agency exec, who says this about his industry.
I don't believe you can assign blame or fault.
Well, somebody's to blame.
Not one single piece of research I have seen predicted the magnitude or course that that the housing bubble would take when it burst.
But some say they should have seen it coming.
I'm sorry. The only people who can say we never knew are people who didn't want to know.
Is Treasury imposing reforms on financial institutions?
Harvard professor Elizabeth Warren is now chairing a congressional panel overseeing the massive federal bailout. She points the finger at the guys at the top of the chain.
These guys are smart guys, though. How could so many of them get it wrong?
Hey, they didn't get it wrong from their point of view. They made big money. Go back and look at the compensation.
What's the toughest question you would pose to these people?
So what do you plan to do now? Here we are. You're rich. But what are the rest of us going to do?
So many of the people we interviewed for this story have suffered, losing homes, losing jobs, all uncertain about their future. But what about those guys at the top? Like James Kane, the former head of Bear Stearns, paid $155 million in his last 5 years on the job. And Lehman Brothers chief Richard Fuld, who with $354 million in pay, collected lavish homes all over the country. Most of the big fish have avoided the cameras.
It seems that the system worked for you, but it didn't seem to work for the rest of the country.
Though Fuld was called in by Congress.
Given the opportunity to look back, I would have done things differently.
But for many, the biggest fish of all was Angelo Mozillo, the charismatic founder of Countrywide, who pocketed nearly $400 million in recent years. 2 years ago, the very public Mozillo told CNBC this.
I don't think I've ever made a loan, a country has ever made a loan, where we believed that the borrower was going to default.
But that was before he resigned, and Countrywide was taken over by Bank of America. So what does he have to say today? We tried repeatedly to reach out to him for an interview, but after his lawyer didn't return our calls, we decided to pay a visit to Mozillo himself. Easier said than done. Once known for his public appearances, Mozillo is now a recluse, apparently holed up down this winding country road outside Los Angeles behind a guarded gate.
Chris Hansen with Dateline NBC. I wanted to try to talk to Angelo Mazzillo.
Okay. Is he invited you to come in?
He's not. I wanted to try to chat with him.
Unfortunately, I can't let you in.
With the layoffs and foreclosures spiraling out of control, the suffering is increasing each day.
Where are you going to go now?
I don't know. There are allegations that some captains of the financial industry knew all along a collapse was inevitable, but still continued to take advantage of the profits. Now, as taxpayers are funding a massive bailout, the public is demanding accountability.
I think the entire industry shares some of that responsibility, and for that we are sorry for it.
But regardless of whether they made millions, was there anyone in the financial world who could answer the question, what was everybody thinking? It turns out there was.
Did you see this coming?
Yes.
Karen Weaver is one of the top analysts at Deutsche Bank, a major player in the mortgage investment business. She says in April 2005, she left the confines of Wall Street and traveled to California to get some answers. She's now credited as being one of the first to figure out what was behind all those mortgages.
It was the first peek behind the green curtain, if you will, sort of, to how these mortgages are being underwritten.
Her mission? To meet in person with the people approving the loans that were being folded into investments. What she found stunned her. Underwriters who did not seem worried about issuing risky loans.
What was disconcerting was it meant that they weren't really vouching for the fact that they were creating a loan that they felt was creditworthy.
She says some underwriters reasoned that before a loan defaulted, a borrower could just refinance and pay it off with yet another risky loan.
They were saying that essentially the problem was going to roll off down the line.
So it was sort of like playing hot potato.
One could argue, yes.
And that risky loan is gone. He's into a different loan, and that's not our problem.
That's exactly right.
In other words, she believed lenders were just putting off the inevitable day of reckoning, though she didn't know just how bad it would get. So in September 2005, her group at Deutsche Bank issued this report predicting subprime mortgage losses will increase significantly and recommending that investors bet against the mortgage market. But she wasn't the only person to see what was happening. James LaLiberty was the chief operating officer at People's Choice Home Loan. He has never spoken publicly before.
And how much did you buy this for?
$135,000.
It was his company that loaned Dolores Parker Jackson nearly $300,000, even though she was basically broke. And with so many loans like that, he admits he knew a crisis was on the horizon. And he even asked Wall Street bankers about it.
The answer was, well, you know, a lot of us see this problem coming. We just don't know what we're going to do.
So let's just ride it as long as we can.
Don't kill the goose that laid the golden egg. The income has to fit.
And listen to what this 15-year veteran of the industry and ultimately a chief operating officer says about his own company.
The reputation of the company was that it was a fraud factory.
A fraud factory?
It was very spotty. The chief appraiser once said, fraud is what we do.
Fraud is what we do?
Fraud is what we do. That's how we got where we are today.
He acknowledges People's Choice was more conservative than a lot of subprime lenders, but says it shared many of the industry's problems, especially those stated income loans, where borrowers didn't have to prove how much they made. How bad was it? He showed us a list of thousands of People's Choice stated income loans, totaling more than $2 billion. He says many were risky, some possibly fraudulent. Example, a massage therapist claimed an income of $15,000 a month, $180,000 a year.
What are the odds, in your opinion, that this massage therapist really makes $15,000 a month?
Well, in my opinion, it would be none.
But People's Choice gave him two loans totaling $640,000. For a carpenter, the income listed was $12,700 a month, more than $150,000 a year. And a house cleaner, $11,500. LaLiberty says he showed the list to the staff members as a training tool so they could see the kinds of loans they needed to stop issuing.
Well, I mean, the initial reaction was laughter. And then I said, well, wait a minute here. And y'all think it's funny. I think it's funny too, sort of. I said, but these are loans that we funded. These are loans that we wired the money on. I said, if you think it's funny, it's kind of funny, but it's not funny anymore. It's not funny anymore.
It wasn't funny because these are the kinds of loans that ended up being sold on Wall Street, the kinds of loans that are at the core of the financial meltdown.
Did People's Choice withhold information about shaky subprime loans to the folks who bought those loans?
Yes.
Did you go to anybody?
I went to our general counsel.
And what happened?
And he felt that we had an obligation to disclose that fact.
And was that information disclosed?
Not that I'm aware of.
La Liberty says that as chief operating officer, setting underwriting guidelines was his responsibility. He says he tried to improve the system, but ran into resistance.
Here I thought I was fighting to keep a company viable, and yet I was perceived to be the guy that was trying to put us out of business.
In the end, La Liberty was fired. Remember, he was one of the company's top executives. And where's his boss, CEO Neil Cornsweet? The company, People's Choice Home Loan, went out of business. But today, Cornsweet lives in this oceanfront home in Southern California. Owns a private plane like this.
VHA utilizes the highest level of ethics and integrity in our auctions.
And works with a business, auctioning foreclosed properties. Cornsweet declined to be interviewed on camera, but told us he believes it's unfair to include People's Choice in this report, saying that his company had higher standards than most and that its loans performed better than average. He denied withholding information from Wall Street investors and denied that underwriters were unduly pressured by salespeople. He also said when senior executives learned of wrongdoing, they took action, firing about 30 employees for violating company policies and cutting off business ties with more than 100 unethical mortgage brokers. In statements to NBC, his spokesman said that People's Choice did everything it could to prevent abuse. He also said it bought back bad loans from Wall Street. We are confident that research will show that People's Choice is the antithesis of the poster child for abuse in subprime lending. According to this letter filed in the People's Choice bankruptcy case, Cornsweet is facing several legal claims, including one that he improperly withdrew more than $13 million of deferred compensation from a company trust. His spokesman says the allegations are untrue. As the nation struggles to recover, will any of the key players be held accountable, even go to jail? With so many involved and so much blame to go around, it could take years to sort out. But as Shakespeare suggested, the fault may not be in our stars, but in ourselves.
If we're honest with ourselves, we'll admit that for too long we have not always met these responsibilities, as a government or as a people. I say this not to lay blame or to look backwards, but because it is only by understanding how we arrived at this moment that we'll be able to lift ourselves out of this predicament.
Where does this leave the average American family?
Crashed and burned. Families are wiped out over this. We're bankrupting people who worked their whole economic lives. And we're saying, hey, this is how markets work.